Sean Howard here from Mortgage Architects. So you're purchasing a home and you're putting more than 20% down on the purchase. The good news is that you're not going to be paying a government insurance premium as you would be if you were putting less than 20% down. The bad news is that the rates aren't as good unless you're putting substantially more than 20% down. Namely, the next threshold is around 35%. If you're putting 35% down, then the rates drop back down again. So those are the two sweet spots. Less than 20%, but you're paying an insurance premium. More than 35%, you also get really good rates and you don't have to pay the insurance premium. If you're putting 20%, between 20 and 35%, then the rates aren't as good. They're still good, and you save the insurance premium, which is also good news. And the other piece of good news is that if you're putting 20% more on the purchase of a property and you're having a hard time qualifying, we can get a little bit more creative on qualifying because the government agency, the government insurer, CMHC, Genworth, Canada Guarantee, are not involved anymore. So we're able to, what we call, stretch out the income and the ratios so that you can qualify for more home than you would otherwise be able to. Because if you're less than 20% down, then there's really no flexibility on the thresholds that you need to meet in order to qualify for the mortgage. And then it gets even more lenient the more you are putting down on the home. If you are putting more than 20% down, the good news is you may be purchasing an investment property, a rental property, where more than 20% or more is required in order to purchase a rental property. And the other good part about qualifying for a rental, which we'll get into in another video, is that you can use a portion or sometimes all of the rental income to qualify for the mortgage. Okay, so it boosts your income when it's a rental property.